It's another week, another series of red arrows. We got Bitcoin down at 18,000. I don't know if you think that's a sign of at least where risk assets are, Michael, but what are you expecting from the Fed? And if everybody expects the Fed to raise at least 75 basis points, does it make sense for the market just to keep coming down? Is this just like a realization each day is just an emotional reaction? Shouldn't have this happened a week or two ago?
Well, first of all, I do think Bitcoin is a little bit of a red herring. I mean, listen, there have been so many assets, whether it be Bitcoin, private equity, spec tech, that all ran because of infinite liquidity provided by global central banks, and that liquidity is being sucked out of the system. So I think the big picture here is not what's happening this week, right? The Fed could go 75 basis points. The Fed might go 100 basis points. Clearly, they're not going 50 basis points. But the big picture is what matters. And the big picture is they are not done tightening. They're not close to done tightening. And I think that's what the markets are starting to wake up to. It's that not just 75 basis points this week. It's that they've got another 150, maybe 200 basis points to go. And that's a lot of tightening to happen when you also consider the tightening that already has happened hasn't even hit the economy yet. So you couple a fair amount of hikes from here on out with slowing earnings growth, and I think that's a terrible recipe for risk assets, credit and equities.
Seema, what do you think the chances are that if we go 200 basis points, that would actually be a lot, that actually puts us into a recession?
Well, I think taking up to 4.5% would certainly be a hit. It would certainly be a hit in terms of financial conditions tightening significantly further, especially considering that's not quite baked into the market expectations just yet now. So we are expecting that tightening to eventually hit the economy. I agree we're going to see a downturn in earnings. And we agree, Q2 is the time where we would expect the U.S. to enter recession.
What would you want to own right now? You could be sitting in cash, put it under your mattress. What would you do?
Yeah, look, it's a particularly difficult time. I mean, looking across the broad asset classes, it's difficult to find kind of opportunities at the moment. We do think that moving into kind of hiding out a little bit in treasuries at the moment, being ready to, whenever the market bottom hits, to be ready with liquidity to deploy, because there will be a ton of opportunities at that point. But at this stage, it's really about playing defense. So we're moving away from high yield credit, away from parts of investment grade. We've been reducing some of our exposure within equities, but really focusing on the U.S. rather than the rest of the world. Although the U.S. looks very challenged, actually, it's in a slightly stronger spot than many other parts of the world. But really the place that we are looking to actually add exposure is still in the real asset space. Right, that is, we're looking at an inflationary environment we think is going to be sustained more than, beyond 2022, beyond even 2023. So stuff like listed infrastructure are decent areas to hide out at this stage.
Michael, what would you be doing in the hideout category?
Yeah, I just don't think this cycle is that exceptional. You think about the global financial crisis, or you think about 2020 and COVID, and those were the exceptional recessions, the exceptional downdrafts in earnings, et cetera, et cetera. Any time before the GFC, the cycle all played out the same. You had too loose monetary conditions and fiscal conditions. You had a Fed that ultimately had to play catch up. You had declining earnings, and a tightening monetary policy lead to an earnings recession and ultimately an economic recession. The playbook is very clear. There are opportunities in defensive equities, staples, healthcare, utilities, high quality dividend payers. On the credit side, you don't want to be in high yield. You don't want to be in private credit. You want to go up in quality, and you want to own long-term treasuries, in our view. If you look at the 20-year point of the curve, you're getting nearly 4%. That's a great place to hide out, clip nearly 4% of income, and wait for a rally, wait for risk off, wait for investors to go and find liquidity in the long end of the interest rate curve, and get a tremendous amount of price appreciation when that happens. And you can deliver very nice returns in the back end of the treasury market. And so, I don't think this is all that unknown what to do. It's defensives and it's interest rate risk treasuries.